Good afternoon. It's Jeffrey Christian of CPM Group. It's about 10 minutes after 3 o'clock in the afternoon in New York, Monday, the 13th of October. We're recording this Monday afternoon because of our schedules on Tuesday. I want to talk about the precious metals prices that have spiked higher today and continuing from the last several weeks, and also talk about silver, understanding the backwardation, arbitrage, and leases, and the fact that Comex has not been in a backwardation despite what some people have been saying. Gold prices are up $123.30 as of right now. They're $4,123. They have basically broken above $4,000, which they were testing late last week. Gold prices have risen very sharply, as have silver prices. Silver prices were up $3.30 right now at $50.55. That's a record price. The price had stopped just below $50 in 1980 and just below $50 in 2011. It has broken above that forcefully today. You've seen the spikes in gold and silver prices, and some of the reasons for those spikes are fundamentals: strong demand, tight supplies in London and in Mumbai. But in addition to that, you have investment demand, and I must say that the tight supplies in both of those places largely reflects investment demand and shorter-term investors, also known as speculative demand, that has been pushing those prices higher. There are some fundamentals there, but there are other factors that are in there as well. And usually when you see gold and silver prices spike this high, sharply higher, it reflects investor and financial market concerns about the economic and political state of the world, 1979, 1980, 2011, and today. But if you look at it, platinum and palladium and copper and aluminum, stocks, bond prices, the dollar, all are rising as well. Those things typically rise during times when the financial markets expect strong economic activity. So you have a seemingly dichotomous situation where precious metals, as the safe haven alternative investments, are rising in lockstep with industrial commodities, stocks and bonds, and the dollar, which tend to be strong during periods of economic strength. What you're seeing is a tremendous amount of money, much of which has been sitting in cash, short-term interest-bearing assets, that is looking for investments. There is a short-term view that economic strength may last for another quarter or two, and then there's a longer-term concern of a very severe economic future, maybe emerging over the next quarter or two, but over the next several years. So investors are buying gold and silver as risk assets and hedges and protection, but they're also deploying capital in other markets where there has been recent strength. Platinum prices also rising very sharply since June. We're seeing another leg up. The price has gotten as high as $1,685 today. It's up about $61. And palladium prices also have risen very sharply, if we can get to that. Palladium prices are up actually $58.40 to $1,529. They are out of that range that they've been in since late 2023. And platinum and palladium may well establish new levels around current prices. Remains to be seen. What we have seen in platinum and palladium is that a lot of the buying has been short-term speculative futures purchases as opposed to physical metal. The physical metal investors that we know are looking at the markets and assessing what's going on Many of them still hold platinum and palladium in their portfolios, and they're trying to see if this is a short-term factor and the prices are going to fall back. They may well sell some metal, or if they think that this is a more permanent increase after a long period from 2014 to until June of this year for platinum, and from late 2023 until now for palladium, they might not sell. They may hold their metal or even buy more. So they're assessing, the physical investors are assessing what to believe and think about platinum and palladium prices and the recent increases since the beginning of June. And the shorter term speculators have been piling into futures. Now, there's a lot of talk about backwardations, arbitrages, and lease rates. And what we're finding, we keep hearing about Comex backwardation late last week, Thursday, Friday, and then over the weekend. And it wasn't there. And it's still not there. If I look at the prices just a few minutes ago when we were preparing this, Comex October spot Comex was $50.20. And the December contract was $50.47. That's a positive forward spread or a contango. It's not a backwardation. And there hasn't really been a backwardation in the Comex silver contract. What we've seen are people looking at other prices and comparing them to the December Comex. So on Friday night at 10:40, the composite of London dealer prices quoting at Friday night at 10:40, compiled by Bloomberg, was about $2.50 higher than the December Comex futures contract. That's not a backwardation. That's an arbitrage. The London market is very tight. The Indian market is very tight. Prices are higher in London and Mumbai than they are in New York. You've got to understand the difference between a backwardation and an arbitrage. Yes, the silver market's very tight, especially in India. There are two funds that invest in silver ETFs in India that have suspended new share purchases until further notice. You can still buy and sell shares of those ETFs in the market, and you can still sell your ETFs in the market, but you can't buy and create new ETF shares by delivering physical metal or having the physical metal delivered on your behalf by a broker. So supplies are tight in India. They're also tight in London, and they're rising. There is a misconception that you need to have physical metal to cover forwards and futures trading. Comex silver inventories were around 100 million ounces for most of the period from the 1970s until recently. Now they're 500 million ounces. That 400 million ounces, by the way, mostly came from London over the last several years. And the reason why supplies of free-floating silver in London are tight is partly because a lot of it went to India and a lot of it went to New York, right? There was an arbitrage. You could buy silver in London at a price cheaper than you could sell it in New York. Cheap enough, the difference, the spread was great enough, the arbitrage was great enough that you could buy in London, ship the metal to New York, sell it in New York, and still have a profit. Now, you would actually buy the stuff in London and sell it in New York for future delivery because it takes time to ship silver. Although right now you're seeing air freighted silver showing up in London to meet the tight supplies there. That's an arbitrage. It's not a backwardation. You're comparing an illiquid late night composite implied average of various quotes that banks and bullion banks and dealers are making in London late at night to a futures contract in New York. That's not a backwardation. That's an arbitrage. And it's an imperfect arbitrage because of the time differential. Right? So there's no published forward prices in London. A forward price in London is determined by individual dealers and brokers and banks, dependent on the credit worthiness of the counterpart that wants to lock in a forward price. So it's very difficult to say what the contango or backwardation is in London because it depends on who you are. We have seen implied forward prices at a discount to spot prices in London over the last 2 or 3 trading days. So that's a short-term backwardation. We saw interest rates shoot up at one point last week to about 35%. That wasn't the record, by the way. The record, 85, 80 to 100% back in the 1990s when Berkshire Hathaway was taking delivery of 129.7 million ounces in the London market. And the lease rate shot up when one of the companies that had sold forward to Berkshire Hathaway's dealer that was handling the purchases in the forward market actually said, oh, we need to deliver this metal. We need to borrow silver to meet our delivery commitments in February. And that caused the lease rate to shoot up to about 80% or 100% briefly. And then it came back down as it did before. But you have to understand the differences between arbitrages and backwardations. It's very important. Now, it's not clear the extent to which the tight physical supplies in London and in Mumbai are due to and reflect tight physical supplies and the extent to which they reflect speculative binge buying. From what we can tell, in Mumbai, it's speculative binge buying of physical metal, and in London, it's speculative binge buying of forward price, futures, spot and forward silver. So it's really a speculative binge buying that is primarily there. As I said, you don't necessarily need that metal to cover your futures and forward and spot trading. So we think that the demand for physical metal in London is not particularly problematic. That suggests that the spike could unwind relatively quickly. There's no squeeze. A squeeze implies intent, usually by one entity. This is not one entity rushing in to buy metal to squeeze the market, to squeeze the shorts. This is a whole lot of speculators buying metal because they think the price is going to spike higher for a variety of reasons. Now, if it were just tight markets in London for silver, why is it that gold is up $100, silver, platinum 56, palladium $24, copper 16 cents? There's clearly other factors driving all commodities, including silver, higher. So you have to pay attention to that. You also have to pay attention that the ships go both ways, as I said last Friday. And the metal that flowed from London to New York can and will flow back to London. And in fact, as I said, some people are actually air freighting silver because the arbitrage, the spread between London prices being higher than New York, are great enough to make it profitable to buy New York, sell London, and air freight some silver back into London against that. Other silver will go by sea because, again, it's not so much an important issue of needing physical silver to meet physical demand at this point in London. So those are some of the things that are going on. You have to understand the difference between spot prices and annual prices. You have to understand the differences between short-term, monthly, quarterly, and annual price projections. And you have to understand and longer-term annual price projections. CPM Group projects monthly prices 3 months out, quarterly prices 8 months out, quarterly average prices 8 months out, 2 years, and annual price projections on a longer-term basis. We take our gold and silver price projections out 10 years. Supply, demand, and price projections under 3 different scenarios is what we publish. We run more than 3 scenarios. And there's a big difference. So if you look at gold, okay, it's $4,105 today. That's incredible. But the average price through October 9th was $3,243. That says to you, yeah, the average price this year may not be $4,100. Price could end at $5,000 by the end of the year, given the state of the world. But that doesn't mean that the average price is going to be $5,000. You know, gold touched $850 in 1980, and the annual average price was like 600 something. And touched $50 almost in 2011, and the average price was something. No, gold peaked in September of 2011, and the average price was around 16 something. Silver has averaged $37.76 through October 9th. The December price got over $50 today. The $50.95 was earlier this morning. Yeah, 9 cents. It's gotten higher since then. But there's a big spread between $37 on a year-to-date average and $50. And I'll show you how that shakes out in a second. Platinum, $1,172 year-to-date, $1,688. Big difference, $500 plus dollar difference. And palladium, $1,064 versus $1,521, about a $460 difference. There's 22% of the year left, 11 weeks. You can project what you think the price might average and what the range of prices might be over the next 11 years, and then calculate with a very simple arithmetic formula what the average annual price would be. And I'll show you some examples for silver. Silver prices, $37.76 year to date, right? The average price that you would need to get to a target price average of for silver to average $40, yet this year, the price would have to average $48 over the next 3 months. That's actually possible. Yeah, it's $2 lower than it is today. May not be likely, but it is possible. To get to $50 on an annual average basis, the silver price would have to reach $94 on average for the next 11 weeks. That's highly unlikely. Kind of put that into your pot when you're trying to decide where the price is going to go. That's all I have for now. We'll be back on Friday, I do believe. In the meantime, you can go to our website. You can buy our gold yearbooks, subscribe to our monthly platinum metals advisory. You can sign up as a retail investor client for some of our shorter term and longer term research. You get the yearbooks, all 3 yearbooks, as part of the retail investor program. And you can send us an email at info@cpmgroup.com and tell us how you think we might be able to help you. That's all I have for now. Take care of yourself. Take care of those around you. Do something good for the world. And let's move forward as a world. Bye.